Hi, everybody, and welcome back to video number 4 in chapter 23. And when we left off, we were doing a review question on disaggregated information. And here is that question. The profession requires disaggregated information in the following ways. Alpha, products or services. Bravo, geographical areas. Charlie, major customers. Delta, all of these. And of course, the answer is Delta, all of these. All right, interim reports. Interim reports cover periods less than 1 year, normally monthly or quarterly or even semi-annually. Two viewpoints exist. Number one, the discrete approach, and number two, the integral approach. Companies should use the same accounting principles for interim reports that they use for annual reports. Pretty obvious, I think, there. So, if we look at a disclosure of selected quarterly data for Tootsie Roll in industries, you'll see that we have quarterly reports for the first, second, third, and fourth quarters and a total. And they break that down by net product sales, product gross margin, net earnings, and net earnings per share. And they also reflect the stock prices and the dividends that were paid in those quarters. Okay, there are some unique problems associated with interim reporting. One, advertising and similar costs. Two, expenses subject to year-end adjustment. Number three, income taxes. Number four, earnings per share. And number five, seasonality. So if I look at the Landry seasonality example here, we have a selling price per unit of $1. We had annual sales projected and actual of 100,000 units at $1 each for a total of $100,000. Our manufacturing costs are variable of 10 cents per unit and fixed costs of 20 cents per unit, or $20,000 for the year as a fixed costs. The non-manufacturing costs are variable for 10 cents per unit, but also 30 cents per unit, or $30,000 for the year's fixed costs. All right, so the first quarter we had $20,000, second quarter only $5,000, third quarter $10,000, and the fourth quarter $65,000. The total for the year was $100,000. So we break those percentage down pretty easily here too by quarter. Now, if we use the discrete approach, Landry manufactures disposable hand warmers. And so the data for Landry are presented in illustrations 23.10 and 23.11 in the textbook. The question is, what is the interim net income information for Landry using the discrete approach? And here, under the discrete approach, they're going to report accounting transactions as they occur. So the following table illustrates that. And as you can see, here is the sales, the variable costs, the fixed costs for manufacturing, and then the non-manufacturing variable and fixed costs, and the total net income. The fixed manufacturing costs are inventoried, so there are equal amounts of fixed costs that do not appear during each quarter. That's alpha here. And then under Bravo fixed costs, the fixed non-manufacturing costs are not inventoriable. So equal amounts of fixed costs appear during each quarter. Okay. So if I look at the integral approach, Landry Company manufactures disposable hand warmers again, and using the interim approach, Landry is going to assign fixed non-manufacturing costs on the basis of sales volume. So, for example, the first quarter represents 20% of sales. Therefore, 20% of the fixed non-manufacturing costs, that's $30,000 times 20%, or $6,000, should be allocated to the first quarter, and you can see that that's what they did. And so they use this approach, and it generates a different level of net income. All right, let's put it into practice. The Acctg Corporation, a publicly traded company, is preparing the interim financial data, which it will issue to its stockholders and the SEC for the fiscal year ending December 31, 2025. Your job as a member of the accounting team is to help determine the appropriate disclosures and any other potential year-end adjustments. You have collected the following information. Number one, Acctg is involved in 4 separate industries. The following information is available for each of those industries. And Acctg wonders which segments are reportable. So here we have Badger, Spartan, Cornhusker, and Hawkeye. Obviously football fans. And we have total revenues, operating profits, and identifiable assets. Number 2, on February 3rd, 2026, one of Acctg's customers declared bankruptcy. At December 31, 2025, this company owed Acctg $15,000, of which $3,000 was paid in January 2026. Number 3, on January 18th, 2026, one of the major plants of the client burned down. Number 4, on January 23rd, 2026, a strike was called at one of Acctg's largest plants, which halted 30% of its production. As of today, February 13th, the strike has not been settled. And number 5, on February 1, 2024, the board of directors adopted a resolution accepting the offer of an investment banker to guarantee the marketing of 1,200,000 of preferred stock. Okay, so the instructions are: Alpha, state each case how the 2025 financial statements would be affected, if at all. And Bravo, moving ahead to the first quarter of 2026, your team has compiled the following summarized revenue and expense data for the first quarter of the year. And you can see we have sales revenue, cost of goods sold, variable and fixed selling expenses. Included in that fixed selling expenses was a single lump sum payment of $800 for internet advertisements for the entire year. So they want you to address the following with respect to the first quarter report. 1, explain whether Acctg should report its operating results for the quarter as if the quarter were a separate reporting period in and of itself, or as if the quarter were an integral part of the annual reporting period. And number 2, state how the sales revenue, cost of goods sold, and fixed selling expenses would be reflected in Acctg's quarterly report prepared for the first quarter of 2026. So for alpha, we'll go back to alpha, state each case and how they would be affected. We're going to look back at the revenue test. We'll take 10% of revenues here, which is $10,200. Badger and Cornhusker segments both meet that test. We'll take a look at the operating profit test. 10% of that is $1,750. Badger and Cornhusker segments, absolute amount, do meet that test. And then the identifiable assets test, 10% of $290,000 or $29,000. Badger and Spartan segments both meet this test. Therefore, Acctg has 3 reportable segments for which segment information should be disclosed. Now, regarding the post-balance sheet events, number 2, the financial statement should be adjusted for the expected loss pertaining to the remaining receivable of $12,000. Such adjustment should reduce accounts receivable to their realizable value as of December 31, 2025. Number 3, we're going to report that fire loss in a footnote to the balance sheet and refer to it in connection with the income statement, since the earnings power is presumably affected. Number 4, strikes are considered general knowledge and therefore disclosure is not required. Many auditors, however, would encourage a disclosure in all cases. And then finally, number 5, we're going to report the action of the new stock issue in a footnote to the balance sheet. For Bravo, the company should report its quarterly results as if each interim period is an integral part of the account of the annual period. Number 2, the company's revenue and expenses would be reported as follows on the quarterly report prepared for the first quarter of 2026. And we have the sales revenue, cost of goods sold, variable selling expenses, and the fixed selling expenses broken down between advertising and other fixed selling expenses. Sales revenue and cost of goods sold receive the same treatment as if they were an annual report. Costs and expenses other than product costs should be charged to expense in interim period as incurred, or allocated among interim periods. Consequently, the variable selling expenses and the portion of fixed selling expenses not related to internet advertising should be reported in full. 1/4 of the internet advertising is reported as an expense in the first quarter, assuming the advertising is constant throughout the year. These costs can be deferred within the fiscal period if the benefits of the expenditure clearly extend beyond the interim period in which the expenditure is made. Okay, so our review question then is, in considering interim financial reporting, how does the profession conclude that such reporting should be viewed? Alpha, as a special type of reporting that need not follow generally accepted accounting principles. Bravo, as useful only if the activity is evenly spread throughout the year so that the estimates are unnecessary. Charlie, as reporting for basic accounting period, and Delta as reporting for an integral part of an annual period. And of course, the answer is as reporting for an integral part of an accounting period. That looks like a good place to end this video. And when we return, we will take a look at our next learning objective.